Okay, good morning and welcome back everyone to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. We have a lot to share with you, so let's go ahead and get started. But before I do, what we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to go over quite a few things, but we're going to always start off with our typical market update so that you get a sense for where the broader indices are currently trading. But the primary theme that we've been on for the last probably close to 2 months now, but has increasingly gotten louder in terms of the warning signals, is really the fact that leadership continues to narrow. It's gotten further narrower, and the breadth of the market continues to worsen. So this is the balance that we currently play in the markets, is the fact that we have a very bullish view, but we have all of these warning signs. So we want to, number one, look at what those warning signs mean, but more importantly, how do you actually trade them? We'll take a look at volatility and silver, how they've kind of decoupled a bit from the markets, some of the themes that we currently see with the market with respect to interest rates and how they're affecting these markets, and looking at economic and COVID metrics. I'm going to spend quite a bit of time here looking at some of the economic data because we have a fairly mixed picture right now from economic data before we take a look at the sector review and the ideas that we currently have here today. And at the very end, if we have a few minutes, we'll open this up for Q&A. But the primary question that I want to help investors answer is really, at this point, still providing a balance to the views that we have in terms of the outlook, because we can sit here all day talking about the warning signs, but at the end of the day, markets continue to grind higher. And the question is just, can markets continue on this path higher from here? And my feeling is that it absolutely can, and I want to show you where I think there are opportunities for this markets to continue moving higher, despite the fact that I think most investors at this point are asking how is it possible, and how much further can it go. Now, what I'm going to do today is I'm going to share with you my charts, the economic research I'm currently looking at, and the indicators and ideas that we currently have for OptionsPlay. So starting off with the NASDAQ 100 index, which has continued to climb to new all-time highs. And what we've consistently said over this whole time as the NASDAQ 100 index continues to climb is the negative divergence that we see in the underlying index. And again, negative divergence is simply a warning sign. It is not a good reason to go out there and to short the markets, as you have seen that despite the negative divergence, markets continue to move higher here. We see negative divergence here on the daily chart, but that largely has resolved itself because momentum has now continued to move higher. So some of that has resolved a bit, and this is exactly what we see, is that you can have negative divergence, have a resolution to that, and markets continue to move higher. So for now, this is not a big concern to us, the negative divergence. We do see it on both the NASDAQ and the S&P 500 because the S&P 500 just this week broke out to new all-time highs. We're just seeing that same thing playing out here right now in the daily and weekly charts here for the S&P 500. But the one thing I will say is that despite this chart looking very similar to what we saw back here in November through February, where we had that negative divergence because as markets pushed higher, momentum was no longer confirming those moves higher. That was a concern for us. Right now, we are seeing the market confirming these moves higher. So as you can see, momentum indicators continue to move higher. So this is stronger. And notice how strong money flow here is on the daily chart, while back here in between November and February, money flow was continually weakening. So the S&P 500, despite trading at fairly stretched valuations, there's no specific sign right now that says that a reversal is pending. You need a catalyst to trigger this type of sell-off, and we simply don't have that catalyst right now. So for those of you that are, asking, is it time to buy puts? Is it time to short the markets? Our thesis remains that it is not time yet to do that, that there's still potential for this markets to continue to grind higher and continue to move to the upside. We do see now leadership narrowing because we've been talking about this, where the health of the market was predominantly okay, but that health has actually deteriorated quite a bit over the past couple of weeks as the major indices, the S&P, the NASDAQ, the Dow, continues to push new all-time highs, but the small cap indices have actually not only not followed through, but is really starting to fall behind on a relative basis. You're seeing this on IWM, that 160 level is continuing to act as resistance. It is below its February highs. It is below its September 2018 highs. So small caps continuing to fall behind here. This is concerning for the health of the market rally. But again, I want to isolate, just because we see that the health of the market is not very healthy does not mean, again, that you should go out there and short the markets. These are warning signs, but warning signs in itself does not mean shorting the markets. We see this across the small caps. We also see it across equal weight. Equal weight not keeping up with market cap indices is also a concern. We're seeing this in the markets. Now, another portion of the market that we don't look at all the time, but has seen some significant deterioration in the last week, is the number of stocks that trade above its 20, 50, and 200-day moving averages. This indicator has continued to decline over the past week as markets pushed beyond, at least the S&P 500 pushed to new all-time highs. We actually saw a decline in both the 20-day, 50-day, and 200-day, the percentage of stocks that are trading above their 20, 50, and 200-day. Normally, you would like to see a market trade, at least confirm the new highs or at least stay level. You don't want to see the number of stocks declining as markets move to new highs. So market breadth continues to weaken here. But again, I want to warn you, make sure that you learn the difference between the two. We did see complacency reverse this week. So as the NASDAQ 100 index climbed to new highs day after day, we saw the volatility index VXN, which is the NASDAQ 100 volatility index, actually climb, meaning investors are fearful. The investors were a little bit more fearful. They weren't as complacent, which actually is a contrarian indicator. This is actually a bullish indicator for the markets. And I know that sounds crazy, but when the volatility indexes spike, those are potential buying opportunities, because every single time you spike, those correspond with market bottoms. So when you get a spike, despite the fact we're making a new high, actually provides more of a bullish thesis here for the markets. And this is something that we think is really important. Now, I think the big news this week is really the Federal Reserve. We're going to take a look at how the markets have reacted to that, specifically in the Treasury market. But for predominantly the changes that the Federal Reserve has stated in terms of inflation actually increase the market's expectation for inflation. So we did see gold and silver respond to this. And this is really where I think that, despite we've been seeing this consolidation here in both gold and silver here over the past couple of weeks, after making this huge run to the upside, we've had this consolidation where it basically stuck within this kind of triangle here. And I think that you might get a breakout here to the upside. But you can do this on gold or silver. We looked at both of these names last night for those of you that joined us during our live market analysis session, and we looked at both a bullish trade for silver as well as gold. We can buy a call spread on silver risking about 5% of the ETF. We can buy a bullish spread on gold risking under 2% of the ETF. Both of them are possible ways to potentially play this this hedge against inflation. So we could potentially now see a breakout after gold and silver consolidating here over the past couple of weeks. But the primary big news this week was the Federal Reserve and the changes that they've made to how they're going to deal with inflation and when they're going to raise interest rates as a result of inflation. And the market actually reacted interesting to that, because the announcement actually should have been sparked a longer term negative view on interest rates. But what we actually saw was a steepening of the curve. We saw that the curve actually got steeper on the tail end of the curve, the longer dated end of the curve. And this reflects the expectation that inflation is going to be higher than expected. And that's exactly what the Fed was doing. But what was most interesting is the Fed funds curve going out to 2021, 2022. Prior, 1 month ago, the expectation was that around June and around August 2021, that the Fed funds curve was actually going to go negative. As you can see now, it is no longer negative, even going out to December 2022. So the markets are no longer expecting negative interest rates. So the steepening of the curve and the expectation that interest rates will not go negative, this has some impacts to specifically financials. And this is really one of the sectors that is the second weakest sector that we have in the S&P 500, but this is one that we think is going to actually benefit from this change in the Treasury curve. So some of the ideas that we have here today is based on that thesis. Now, the one bright spot when we look at economic indicators is housing. This is really one of the only parts of the economic numbers that are at near all-time highs, or if not multi-year highs. So if we look at housing home sales, we are at multi-year highs, almost a decade. Going back a decade, we are at some of the highest levels we've ever seen. Pending home sales, also a bit of a decline, but as you can see, well above same time every year over the past 10 years. So housing extremely strong. And this is part of why, we have the long trade in Home Depot, and also a lot of other names, whether you're looking at the home builders, you're looking at Lowe's, there are a lot of different potential beneficiaries, whether you're talking about furniture like Wayfair or Restoration Hardware, any of the lumber suppliers. This is a broad industry, so you have a lot of potential opportunities. Home Depot is just an example, and you can utilize this theme and apply it to quite a few different names within the housing or home improvement or furniture space. So housing, we expect, is going to play a big role in the second half, or the recovery in the second half of 2020. We do have some good news also on the COVID-19 front, because we've seen a fairly, I would say, steady decline in the number of cases, in the number of cases that come back with a positive, or the ratio of number of cases coming back positive, number of deaths, number of hospitalizations. These have all been steadily declining here over the past few weeks. Now, we have not quite seen this decline come through in any of the economic numbers yet. This is one of the things that we're really paying attention to, because we do need a decline in these numbers in order to see some kind of pickup in some of the economic indicators. Consumer confidence did have a substantial downtick here in August. That was a surprise to us to the downside, but we have had many manufacturing indices actually surprise to the upside. So very mixed picture, but considering that consumer spending was what triggered a 25% decline in our GDP, that is really the part that I think is most sensitive to some of the economic data. So whether you're looking at housing recovery, whether you're looking at employment data, it's a pretty mixed bag here at the end of the day. And the decline that we've currently seen in COVID cases hasn't quite picked up anywhere, because if we look at mobility data, this is really real-time tracking of whether people are actually getting out there and doing things and potentially spending money. And the answer to that question is that has not happened since pretty much the beginning of June. There's only one area, the Northeast, that has seen a slight uptick, but the Midwest, the West, the South have seen zero gains on this front here over the past 2 months now. And that is a concern to us, that all the way through June, all the way through July, and now all the way through August, we have not seen an uptick. And we're seeing this in the employment data. We've recently had, after 4 weeks of declines of unemployment claims, we actually saw last week pick up a little over 1 million claims again, after we declined below 1 million. We want to make sure that we keep an eye out here for this specific economic indicators, employment. We do expect employment to actually pick up a little. At this point, we're modeling about 47% of jobs that have been lost due to COVID-19 have resumed employment. So that's about close to 50%, but not quite there. We do expect unemployment to actually fall below 10% here, which reports here, I believe, next Friday, unemployment and non-farm payroll. That is a big one that we're paying attention to. The markets have historically reacted very positively over the past couple of months here to non-farm payroll. So keep an eye out if that comes out next Friday. And we're gonna also keep you updated on that when we report here next week. So some of the sectors that I want to pay attention to here, XLKs, right now there are only 3 sectors that are outperforming the S&P 500 year to date, and that's technology, consumer discretionary, and communication. So I wanted to take a look at these three first, because there certainly are signs of exhaustion here, but the chart looks very similar as far as XLK to the QQQ index. You have this massive negative divergence, but the one thing I will say is that recently, as the market continued to push higher, we did get confirmation on momentum indicators, and money flow remains strong. So this is why, despite the signs of exhaustion, we believe that technology with a small pullback here can really continue to move higher. Despite the stretch valuations, despite everything that we talk about in terms of market breadth, this is still the number one sector, and there is still potentially room to grow here to the upside despite the exhaustion here. Do we see the same thing here on consumer discretionary? Yes. However, what's interesting here is that consumer discretionary actually now no longer has negative divergence. It has actually resolved that. So, and as markets continue to push higher, momentum indicators also confirming those new highs, and money flow remains fairly strong. So this is another segment of the market. And I do want to point out here, XLK, XLY, XLC, these are all market cap weighted indices, which means that what we're seeing here is not necessarily a whole sector continuing to accelerate. What we're seeing is a few dominant names dragging the whole index higher. So when you're looking at XLY, we're predominantly talking about Amazon, Home Depot, Starbucks, McDonald's. These are the names that are dragging this index up, while the rest of the industry and the rest of the sector is actually falling behind. And that's exactly what we're seeing. How is that going to resolve itself? I'm not sure. How long can this go on for? Also not sure. But the answer is that it can go on for quite some time, because Amazon, Home Depot can continue to swallow up smaller businesses and actually shift consumer spending away from these smaller businesses to those businesses. And as long as Amazon, Home Depot, and some of these major companies are more efficient and being more productive, these indices can continue to go higher. That is I would say probably one of the more difficult parts to grasp and continue to push long positions in these types of markets, despite everything that we're seeing. And I will say that, I think that that's probably one of the more difficult positions that I'm in, to try to warn everyone about these warning signs, but at the same time still continue to push long positions. But that is part of why it's so important that we use option strategies like call and call debit spreads to play for these further moves to the upside, because in those plays, we're risking anywhere from 3 to 5% of the underlying stock or ETF to place these bets. For those of you that were able to join us here last night, I highly recommend you to go back and watch that recording, because we went through a lot of ideas, a lot of symbols. And not only did we go through the ideas, we also went through how I would play them utilizing options, because that, I think, is the most important lesson to learn here in the current market environment, is not necessarily where can the markets go, but more importantly, how do you play the markets at these types of stretch valuations. So before we end here, I will show everyone a link to that recording if you did miss last night's session. Last thing, communications. Similar type chart as communications continue to move higher here. We have negative divergence here on the daily chart, but on the weekly chart. But again, on the daily chart, as this market continues to push higher, we're seeing momentum confirming those new highs. There is a bit of divergence here on the money flow here, so we might see a bit more of a correction here on communications. So these are the three sectors that at this point, while I expect to continue to moving higher, I do think that you're going to get a bit of a short-term pullback here in some of these sectors. My preference actually right now is to look for opportunities in some of the weaker sectors that are now starting to rotate into some strength here, and potentially XLF. XLF is by far out of these my favorite, because you have the rise in interest rates. So we've seen the 10-year yield now rise to above 70 basis points. We've seen the yield curve rise across the board, and we've seen it steepen, and that is good for banks because they can borrow at very short-term interest rates, lend at relatively higher interest rates. And this is, again, and out of all the banks, I have a few that I like, but XLF as a whole, if you look at any of the major banks, you're going to see, in my opinion, some opportunities. And this is really a potential breakout opportunity here for XLF. And we're about to get this, you have this triangle here. You also have the 200-day moving average. And this is really where you could see some long-term gains here for XLF, and sort of a reversal here from the second worst performing sector and start climbing in those rankings. Industrials is one that we pointed to a couple of weeks ago. However, we have this now double top here, and I do think that we could potentially get a breakout here for XLI. We see some specific names within the sector, whether you're looking at John Deere and some names that you can pick out that have been extremely strong, that is the catalyst for this to continue to break out. Those are the strong names that I want to focus on in this specific sector. If you're looking to play that breakout, I think it's better to play specific names rather than the whole sector, because the whole sector is a very mixed bag here at the moment. Just like banks, I think there are some stronger banks like Morgan Stanley, Bank of America. Those are the ones that you might want to pay attention to. Healthcare. We talked about healthcare here actually 2 weeks ago when we did a sector review. And healthcare is, again, we talked about the consolidation that we've seen, and healthcare continues to make a higher high while pushing against that 107, 108 resistance level. Looks like we're about to push out higher here to the upside here in this morning. There is some exhaustion here, but as you can see, money flow remains strong here, and that's one of the reasons that I'm looking at this for a potential breakout here on both the daily and weekly chart. I don't have any specific names that I'm looking at currently in XLV. I will take a look at it and I will share with you any names that come up, but at the moment, I don't have any specific examples of names. But within financials, Morgan Stanley is one that I'm paying attention to. This is one that we talked about here last night also. As you can see, Morgan Stanley here trading just in this triangle here, about to break out. You know, the level that I'm really paying attention to is $53. I'm looking for a breakout here above 53 and for this to continue moving higher. Morgan Stanley reports here in early and mid-October here. So I was going out to October looking at the 52.5, 57.5 vertical spread here. Those types of plays, you know, risking only about 4.5% of the underlying stock price. Those are the types of plays that I'm looking for here in a name like Morgan Stanley. But you can look at it, Bank of America, you can look at quite a few different names here that all have the same type of setup. Another one that we've talked about is housing and how strong housing is. So DR Horton, the home builder, this is one that I'm also paying attention to. What I liked about this is that you have very strong strength here, very clean chart. You've got a recent pullback here, and I think this recent pullback is the potential opportunity that you have to look for a continuation higher. You might hear me all the time saying that, you know, I prefer when stocks like this get stretched to see a pullback here before you go long. You've gotten a pullback here just within 1% of the 20-day moving average. Those are the types of opportunities that you want to see. This is a weakness within a stronger bullish trend. That is the type of weakness that you want to see as you look for long opportunities. So when you have a strong sector that you have a strong fundamental thesis on, you have a strong stock that has a temporary pullback here, those are your opportunities for the highest probability trades. You would want to use something like a call or call spread again to risk a relatively small amount of capital. And also, if this does continue to decline, if it gets into that $68 or potentially a little lower, you would cut your losses and you would probably only risk in that point, you know, 30 to 40% of the premium that you paid for that call or call spread. So you're actually risking substantially less than what you've paid for that call or call spread. So those are the reasons why I like to use those types of strategies, especially in this type of market environment where you can really limit the amount of risk that you're taking and still get potentially that full upside, because these are the highest probability trades that you can make. Another one that I was looking at is Disney. So in the communications, we were looking at communications. Now, within communications, you have a lot of very strong stocks. Disney happens to be one that's turning around here. Now, yes, I was bearish here on Disney going into earnings, but that actually turned around to be quite positive in terms of Disney Plus. The numbers surprised us here to the upside. And what I liked about this chart here for Disney is that after breaking out above earnings, it came back to retest this and is now broken out above that 130 level or so, and looks like it's continued to push higher here. Now, what I do think is interesting about Disney is that you now have three interesting, I would say, confluences at play here with Disney. You have sports that are potentially starting to come back onto, especially with the COVID-19 data that I was just showing you. If we do start to see a pickup here in terms of potentially reopening up theme parks, reopening up sports, these are all two things that are going to be extremely beneficial, because those are the two areas of the business that Disney has been hurting on the most. So any type of surprise to the upside, I think you could see some substantial gains gains to the upside, because I think many people still very much like Disney as a company, fundamentally speaking. They have obviously had some significant headwinds as a result of COVID. So as those start to resolve itself, or any good news on vaccine news, those are these are the types of stocks that I think you're going to see a very big pop, that are outside of the traditional travel stocks, hotel stocks, cruise stocks that you're going to see, that in my opinion has a much more stronger balance sheet than some of the airlines and cruise stocks, out of the reopening trades. Another theme that we still always have continued to like here in 2020 is cybersecurity. We believe that cybersecurity is going to play a big role here over the next decade. If you see, some of the big news, such as TikTok, the reason, all the U.S. trade war stuff at this moment is really based on more intellectual property theft, cybersecurity, these types of related things. If we think about, what 2020 and the next decade is going to bring, it's likely going to be wars, not on battlefields in the traditional way, but in cybersecurity. And this is really where names like this are ones that we're paying attention to. And we recently got a consolidation after a very long rally, a brief consolidation, and now we're starting to break up here to the upside. So CrowdStrike, again, one of the names that I like. One of the things that I also like about this particular setup is that we're playing for a breakout here, but if, let's say, this breakout fails and maybe gets back into the 105 range, which is below the 20-day moving average, this puts us back into this kind of trading range. I would say then that breakout failed. And again, if you buy a call or a call spread and the stock declines roughly $10 or so, you're not risking the full premium that you paid for that call option or that call spread. You're looking at probably risking closer to 40 to 50%. You would cut your losses and get out of that trade. So those are the types of risk rewards that I'm looking for in this type of market opportunity, where I admit that the warning signs are there as far as a potential pullback, but we don't have a catalyst. And the one thing that I still want to, again, reiterate is that catalyst could trigger tomorrow, right? We just don't know what that is, but that catalyst could come tomorrow. It could come next week. It could come next month, but it could also come next year. We don't know when that catalyst is going to come. So you want to be prepared. You want to know, you want to say that if that catalyst gets triggered tomorrow and we see markets fall 5, 10% in a very short amount of time, how much exposure do I have in the markets? When markets reach all-time highs, what you generally want to do is you want to reduce exposure. As you can see in our daily plays, we've been reducing exposure here this past week as markets get to new all-time highs. We're waiting for a bit of a pullback here to add more exposure, and because we want to better our risk reward ratios on all of our trades, such as the DR Horton one. We want to make sure that when markets correct, we get into them at the best possible risk reward ratio. So if you do get a pullback, you're risking a small amount of capital. If markets continue to move higher, you have a nice risk reward ratio. That's how you want to position for this market, not go out there and short the markets because you see these warning signs. So I hope that was clear as far as how we're currently viewing this market, what data points we're paying attention to, and more importantly, what ideas and how we're positioning for that. So with that, I want to thank everyone for taking the time out here this morning. I really hope that you guys find this useful, and I know many of you are asking about the segment from last night. So I will send everyone off with the link to yesterday's session. Let me see if I can find it, actually. There we go. Nope, that's not what I was looking for. Oh, this is it, yeah. I will send everyone here this link so that you can watch yesterday's live market analysis session. I think for those of you that are wondering, how do I position for this market? We spent a lot of time yesterday going through a lot of examples, showing you how I would think about, whether or not if this is a stock that I would consider entertaining, and if it was, why I would use certain strategies to play it versus others. So please take a look at that for the for a better understanding as to how we're positioning for this market. So thank you so much. I really appreciate everyone taking the time out here, and especially the members for supporting us and allowing us to continue to do this. So I'll send a link to everyone for those of you that are still on a free trial to subscribe to being a member so that you can get recordings like this in your inbox once we finish here today. And if you don't have a free trial, you can sign up at OptionsPlay.com, which I will also post a link into the chat window. So have a great Friday. I'll see you guys on CNBC later tonight, and I'll see you guys also next week on Tuesday. Have a great day.